wanted to come to New York and be the accounting beat reporter for the national paper. And the editor at the time, great guy, Larry Ingrassia, we're still in touch, great friend. And I don't remember if he remembers a story, but he said, "Look, I've read your stories since you've been down in Texas, and you've had a great run on exposing a lot of frauds and starting investigations, but I've never heard of any of these companies. How about you tear apart the books of a company I've heard of before, and then we'll talk about the accounting beat." And I had Enron and Dynegy on the shelf, so that kind of gave me extra motivation
Yeah.
to start digging on those. And once you could figure out that, if you want to talk a little geek speak here,
Yeah.
what the line on their balance sheet on the current assets, current liabilities, long-term assets, long-term liabilities, risk management activities. That was the name of the asset and the liability. Once you could figure out that all those meant were unrealized losses and unrealized gains.
Yeah.
Oh, and then if you took the net change in those four numbers every quarter, you could tie it back exactly to a single line item on the operating cash flow statement. I didn't figure all this out myself. My friend in the investment management business had, shown me, look, here's the arithmetic. And this is how you can get to the point that these are their unrealized gains. And you can take that as a percentage of any pre-tax number you want. And in their case, the particular quarter that I happened to be writing that, I wrote about it in September. At Dynegy, it was their unrealized gains were some massive percentage of their EBIT, their earnings before interest and taxes.
Yep.
At Enron, they exceeded EBIT. At El Paso, they didn't give you enough numbers to be able to tell. So they actually thought El Paso was probably, the craziest of them all. That's how the story came about. The headline on it was "Energy Trader Cite Gains, but some math is missing."